Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The AI-fueled rally rolls on. Nvidia delivering on the hype, reporting results, beating already lofty expectations. The chipmaker shares surge in after-hours trading.
The industry is going through a major change. Let me give you some perspective on the importance of the transformation. The next industrial revolution has begun.
US and European futures point higher on renewed tech optimism. Fed minutes show policymakers rallying around the higher for longer view on rates. Plus, the UK Prime Minister hopes for brighter days ahead, staking his political future on an improving economy as he calls a surprise summer general election. Labour leader Keir Starmer says it's time for change. Let's check in on these markets then. It is a risk on, and thank you to Nvidia for that. Looking past the Fed minutes and the hawkishness that was baked within those comments, it's the Nvidia and it's the beat coming through for the first quarter and the forecasts around the second quarter that is propelling the momentum in European equities and US stocks as well. Let's show the pricing right now. It is set to be a decent day for these equity markets. You're pointing higher by 0.3% on European futures. FTSE 100 looking to add just 2 basis points. Flat on the FTSE 100 futures picture. The commodities story and the pressure coming through there is likely to be weighing on the UK's major index. The S&P 500, though, looking to build on the gains, up 0.6%. It ended lower yesterday, but again, the upside coming through from the optimism around Nvidia. Nasdaq futures looking at a full 1 percentage point in gains. Let's look then after hours at the Nvidia pricing on the back of the beat. And again, the forecast that in the current quarter, revenues are going to come in at about $28 billion US dollars. The upside in aftermarkets then 6%. You're looking at adding around 140 billion US dollars, 140 billion US dollars in market cap. That's equivalent, by the way, of the market cap of Intel or thereabouts, above $1,000 per share. Let's flip the board now. Look cross asset. Nvidia, by the way, and that story and that theme is going to be threaded through this show. Cross asset. Let's look at what's happening in the Treasury market. Of course, you did see a bit of a reaction to what seemed like more hawkish minutes, but the context is those minutes came in, of course, before that slightly softer CPI print, inflation print out of the US. But nonetheless, there were many who questioned whether or not rates are at restrictive levels. Those coming through from those FOMC minutes. The 10-year currently at 4.42. Not a little movement right now. The pound, of course, in focus for us on the back of that decision to call that election July the 4th here in the UK. 127, $81 a barrel on Brent, and copper at 10,347, down 0.7%. Let's cross over to Asia, where Avril Hong is standing by in Singapore. Avril, how are the Asian markets faring?
It's a mixed bag, Tom, despite that tailwind from Nvidia that's helping the AI and chip-related stocks. And that's happening in Japan, particularly where the Nikkei is outperforming. And along with some of the further boosts we're getting from the South Korean chip makers against the backdrop of a government that's just unveiled a $19 billion chip support package, which helped the Kospi to flip into the green. There are tailwinds, or headwinds, I should say, to contend with. Think about the geopolitical angst, China holding the largest military drills of Taiwan in a year, and sentiment also turning towards the tech sector. The Alibaba stock is the big drag on the Hang Seng. The commodities-related names, materials ones, are the ones that are underperforming on CSI 300 as the likes of copper and iron ore retreat from recent highs. Let's flip the board because we talked about how this FOMC minutes is sounding a bit hawkish, maybe not particularly concerning given how that CPI print recently came in softer, but we did see a bit of an initial reaction in Asia FX, and I think feeding into the story of dollar resilience, we got the PBOC today coming through with a fix that was the weakest since January, and perhaps this signals that it's allowing the currency to weaken. Dollar China moving around the 725 handle. Yen is in focus, popping towards 156.9 earlier, a bit of a recovery there. Flip the board again. Let's take a look at the Asia chip stocks and the ones that are benefiting from Nvidia's stellar scorecard, as we saw the likes of TSMC and SK Hynix really bucking the trend where most of Asia stocks are actually treading water or in negative territory today. So these are the ones that are in the green. Disco as well in Japan, really feeling what we got from Nvidia, Tom.
OK, Ava Hong in Singapore, thank you very much indeed for the Nvidia read across to the Asian session. Staying on that story and getting more analysis now. The chip maker at the centre, of course, of the AI boom, surging in late trading after smashing expectations and delivering a bullish sales forecast. CEO Jensen Huang further stoked the excitement by talking about the dawning of a new era.
The next industrial revolution has begun. Companies and countries are partnering with Nvidia to shift the trillion-dollar installed base of traditional data centers to accelerated computing and build a new type of data center, AI factories, to produce a new commodity, artificial intelligence.
OK, for more on this, let's bring in Matt Bloxham from Bloomberg Intelligence. Any other CEO who came out and described their business or their sector as the next industrial revolution would be looked at with at least a concern that would be hyperbole. But the data, the numbers seem to suggest that you have to take this seriously from Jensen Huang. How long, Matt, can they keep up this incredible growth?
Well, it's a good question. I guess that's a question people are really asking themselves a lot more now, given there's been such a massive ramp in their revenue, tripling of revenue year over year in that quarter and still going on. Now, interestingly, yesterday, the CEO said that they've got more demand than they can meet and they expect that to carry on into next year. So I think at least for the near term, that kind of excitement is going to be sustained and people have to kind of push those kind of bigger picture thoughts further out. I think when you think about what's coming up next in the broader tech space, we've got the Apple AI update at the Worldwide Developer Conference in June. That's inevitably going to stoke the excitement even further. Then they'll have that iPhone launch in September, which is probably going to have more AI features in the hardware. So I think there's just a lot of news flow coming that's really going to sustain this excitement and this idea that we are entering a new industrial revolution. This whole idea that data centers aren't data centers anymore, they're AI factories, kind of a complete rebranding of that whole sector. So, I think for now, at least, the momentum is with them.
OK, so you see the momentum sticking with Nvidia for now. We look at some of the competitive threats. They're still quite nascent, aren't they, when it comes to Nvidia? Or are they catching up? What is the catch-up? What is the competitive threat? What are the challenges for this business?
They are catching up, but I guess there's kind of two ideas here. You've kind of got the Grace Hopper chips, which is their kind of current bread and butter, and then you've got this new Blackwell chip, which is really super advanced. So I think a lot of the kind of catch-up is at that kind of more kind of current technology level, and they continue to kind of keep ahead of the competition with those advanced chips, and that's really going to drive quite a bit of their revenue this year. And they're even more expensive chips than the Grace Hopper chips, which are expensive anyway. So I think that helps Nvidia's revenue, and it helps to keep their lead, at least for now, in terms of that real cutting edge. And if you're doing large language model training, really complex inference on that data, then you're going to need those new Blackwell chips that are coming. And so I think that's going to help them sustain that edge for now.
OK, and the pricing around $70,000, according to some reporting, for one of these individual GPUs or chips. Matt Bloxham, thank you very much indeed, with the deep dive, of course, on the earnings coming out of Nvidia and the implications for the broader sector. From tech to politics now. UK Prime Minister Rishi Sunak's surprise call for a July the 4th election sets up his Conservative Party for a 6-week battle to stop the Labour opposition from taking power.
Now is the moment for Britain to choose its future, to decide whether we want to build on the progress we have made or risk going back to square one with no plan and no certainty. Earlier today, I spoke with His Majesty the King to request the dissolution of Parliament. The King has granted this request, and we will have a general election on the 4th of July.
OK, joined now by Lizzie Burden, our UK correspondent, who's on the ground outside Downing Street, at Downing Street yesterday for that announcement, that surprise announcement. Lizzie, why? I guess the question on many people's lips this morning will be, and yesterday will be, why choosing July the 4th? Why not push it back later in the year? Why has he come through with a summer election?
Yeah, why on earth would you call an election when people are on their summer holidays? I hear you ask it, Tom, but Rishi Sunak here has managed to put a pin in all that speculation over when this election is going to be and who's going to lead the Conservatives into it. We know now, July the 4th, Rishi Sunak. But it's fair to say he surprised most people in Westminster with this announcement yesterday, including many of his own ministers, including, we report, his Chancellor, Jeremy Hunt. But why has he chosen July the 4th? Well, First of all, it was no coincidence that yesterday it was announced inflation fell to 2.3%, back to normal, in the words of Rishi Sunak. Not quite so in the eyes of markets. They think inflation is so sticky, a June cut is now off the table for the Bank of England, but nonetheless, Sunak going to present to the country that he has been the Prime Minister who's managed to recover the UK economy. He's also, of course, going to have had an eye on the polls, and Labour's poll lead over the Conservatives has only widened despite inflation falling. It managed to halve last year under Sunak's watch, though maybe that's more because of the Bank of England's contribution, and now, as I say, back to 2.3%. But I say about that poll lead, Tom, now it's Starmer's task to turn that poll lead into votes, and he has got on his hands the biggest turnaround in post-war electoral history if he's to just even get into number 10 because of the dismal performance of his predecessor Jeremy Corbyn at the 2019 general election.
OK, Lizzie Burton outside the Houses of Parliament all over this story, of course. Lizzie, thank you very much indeed. Now, to central bank policy from the BOE to the Fed. Minutes from the Fed signalled that officials were in no rush to cut rates, with, quote, many questioning whether a higher for longer policy was restrictive enough. For more, let's bring in MLive strategist Garfield Reynolds. Garfield, the markets did react to this. It came in, of course, before those Nvidia results. How much of a surprise was it, the hawkishness that came through, relative, at least, within these FOMC minutes?
Oh, it was definitely a surprise. A lot of people were saying this sounds much more hawkish than Powell sounded when he came out at the press conference immediately following the actual meeting. And if you cast your mind back to that day, the market had gone into that meeting very worried that there was going to be a hawkish pivot, that there were going to be rate hikes discussed, and therefore when that didn't happen, there were strong rallies in bonds and stocks. So there's a bit of a feeling that Powell undersold the way that the Fed was firming towards a more hawkish view. And even if you take into account the idea that these minutes come after those softer jobs and CPI numbers, remember, Wallace was describing the most recent inflation report as a C+. So in that context, you've still got a very strong move towards staying on hold. It's going to be fascinating going into the next meeting in June when we get a dot plots update. The current dot plot calls for 3 cuts. We know we're not getting that. The question is going to be, are they going to call for 2 or for 1 cut? And as you were highlighting, the market at the moment sees 1.5. So the outlook is very balanced, but we've had a strong move this week towards a more restrictive in general attitude from central banks. Not only in the US, we also had Australia and New Zealand expressing something along those lines. And of course, that UK CPI report, which was slower, but not as slow as was wanted. So bond investors are not in a great spot at the moment as they worry about how far inflation can come down, and therefore how soon and how many rate cuts you can see from the various central banks.
Excellent context. MLive strategist Garfield Reynolds on those Fed minutes, and looking ahead, of course, to the importance of the dot plots and the revisions coming through in June. Garfield, thank you. Coming up, the UK surprise summer election. I'm going to be speaking to former press advisor to the Conservative Party, Gavin Megaw, about whether this could be the end of 14 years of Tory rule. That conversation is next. This is Bloomberg. Welcome back. UK Prime Minister Rishi Sunak has set the date then for a surprise summer general election, July the 4th. It gives the Conservative Party 6 weeks to overcome a Labour Party poll lead averaging more than 20 points.
Our offer is to reset both our economy and our politics so that they once again serve the interests of working people. We totally reject the Tory view that economic strength is somehow gifted from those at the top. Over the past 14 years, through all the crises we've had to face, sticking with that idea has left our country exposed, insecure, and unable to unlock the potential of every community.
OK, for more on this, I'm very pleased. Pleased to say I'm joined by Gavin Megaw, President and Managing Director of Hanover Communications. Gavin has also, importantly, held a number of senior roles on the UK Conservative Party's media team, including head of their rapid rebuttal operation. Joining me now, Gavin, first off, your reaction to the way this was handled yesterday by the Prime Minister and his team. Have they set themselves up on a surer footing?
Tom, it was utterly shambolic. The optics of yesterday were nothing that any of us would have wanted if we'd been setting up a launch of a campaign. Doing it in the rain, the things can only get better blurring out in the background. They didn't take control of the situation. They let rumours run wild all day. And when he looks behind him, he didn't have his party there supporting what he was announcing. That's shambolic.
And Gavin, a lot of questions, of course, coming from his own party, members of the public, as to why he called this for the summer, July the 4th, and not give himself more time, him and his team, to see possibly better economic data, more policy achievements, and push it into the autumn. What is your view on the timing of this election?
Again, this has left many people in disbelief. Why now? Many reasons why he shouldn't have gone ahead with the announcement for July. Not only Scotland being a mess and the SNP falling apart, meaning Labour will dominate there, which means a bigger majority for them. The fact that they don't have the legislative programme through Parliament in time. And thirdly, they don't have the candidates in seats. So they're going to have to scrape around to get those in place. The only two reasons for doing this now, as you say, are they maybe don't think the economic situation is going to get any better in the long run, and they don't have the fiscal room they thought they might have to make some economic announcements in the autumn. But also, the truth is, Rishi wants out. He's been held hostage by his own party. He's not very happy about it, particularly since Christmas. And this is a let's get out of here moment.
To be clear, Gavin, you think this is a Prime Minister who's giving up, rather than a Prime Minister who's taking a brave gamble?
Absolutely. After the local elections, the Prime Minister announced that there might be a hung Parliament. That was his play. He was in effect saying, we're not going to win the election, we can only hold Labour off to a certain extent. Now, that's not only a daft political move, because it gives the Labour Party something to turn the vote out with by saying the election's going to be close. Because the worst thing that can happen for Labour here is that they look like they're going to get a massive landslide and people don't turn out to vote. Rishi's not only admitted that they're not going to win, his party knows they're not going to win. And their big danger here is this is just a terrible, terrible campaign for them. Their only hope is and Labour find a reason to self-sabotage where they are. They have a Ming Veiz strategy. They're trying to carry that Ming Veiz across the room without dropping him.
Gavin, very briefly, his team no doubt would suggest, look, the growth prospects of the UK have turned around. The IMF now sees 0.7% growth this year. Inflation is back with a two-handle, 2.3%. They can build on that economic momentum, maybe would be the case from his team. Is there even the possibility of that? Is that a rational case for this team?
I think it's a rational case for rational people. But remember, there's two different perspectives here. There's the Conservative and Rishi Sunak perspective, which is we're making things better. I personally, as Prime Minister, am starting to make things better and trying to detoxify the party. And there's an element of truth to that, Tom. But ultimately, the other argument is the country needs change. And that's what Rishi Sunak's going to face from Keir Starmer. And I think the reality is we might all be rational about economics, but the public, the voting public at large, just want some change. They've had enough. And that's a really dangerous position for the Conservative Party.
Gavin Megaw, President and MD at Hanover Communications and former head of the Conservative Party's rapid rebuttal operation, with a scathing take there and a very straightforward and honest take on the expectations and the implications of this July the 4th vote for, of course, the UK Prime Minister and his Conservative Party. Gavin, thank you very much indeed. Coming up, two other matters in the mining space. BHP winning an extra week to convince Anglo American on its $49 billion takeover plan. Will that be enough, though, in terms of the timing to iron out a deal? More on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, BHP has won an extra week to convince Anglo American on its $49 billion takeover plan. After a month of rising tensions, the companies are holding talks after BHP raised the value of its proposal for a third time earlier this week. Let's get the details then and bring in Bloomberg's Martin Ritchie, who has been covering this story right from the start for us in all its detail. Martin, it looks positive then for BHP. They get this 1 week extension. Talk to us about how the agreement, or at least the discussions, are moving forward. What sense do we get that's coming through from both these parties at this point?
Yes, Tom, the saga continues. We did think it was sort of make or break time yesterday, but as you said, BHP gets another week to come up with a firm bid. And I think the most important thing here is that the Anglo management are talking with BHP for the first time. BHP, the world's biggest mining company, has produced 3 offers already, all refused. But now they are sort of in proper negotiations, at least. That's looking at it positively from the BHP point of view. They have to iron out, possibly the most important part is ironing out sort of complexities around the deal in South Africa. Anglo is a complicated company, and BHP's bid is seen as quite complicated because it's a multi-step bid where some assets have to get sold first.
OK, Martin, $49 billion question. What is it going to take to get this deal over the line?
Well, as we were saying, it's all about South Africa, really. Anglo is a very complicated company, partly because it has majority stakes in 2 major South African companies, an iron ore producer and a platinum miner. BHP wants Anglo to sell those companies first before it then buys the remainder. The problem with that is it leaves Anglo shareholders open to exposed to a lot of regulatory risks. If South African government was to impose some conditions on those spin-offs or on those companies after that, so the BHP really has to address that to reassure Anglo shareholders and reassure regulators in South Africa that its plan is satisfactory from their point of view. At the same time, it's obviously got to be mindful of BHP's shareholders. I think there's less room for them to lift the offer significantly more, but there may be some wriggle in the structure and the conditions.
OK, Bloomberg's Martin Ritchie on this proposed and potential deal and how it's moving forward, potentially, in terms of BHP and Anglo American and that 1 week extension. Martin, thank you very much indeed, joining us out of Shanghai. Staying with the sector, Glencore is keeping its contract with Russian aluminium giant Rusal for at least another year. That's despite sales volumes dwindling and international sanctions. Bloomberg understands the deal for delivery of more than 1 million tonnes of aluminium a year has been rolled over into early 2026. Since the second half of 2023, Rusal has been shipping only a fraction of that amount. Let's briefly check in the commodity space because there's a bit of pressure coming through across copper, across oil and iron ore. Hawkish comments within those Fed minutes certainly not helping. That's part of the mix. But also it seems buyers, Chinese buyers, so important within the copper space, bulking at some of those record high prices. Of course, you crossed above 11,000. You're now at 10,348 on copper, down 0.7%. That's a third straight session of losses for copper, 4 straight session of losses for oil, $81.46. And iron ore taking a hit as well, down 2% in the session. There's plenty more coming up. Stay with us. This is Bloomberg. Good morning, happy Thursday. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The AI-fueled rally rolls on. Nvidia delivering on the hype, reporting results beating already lofty expectations. The chipmaker's shares surge in after-hours trading.
The industry is going through a major change. Let me give you some perspective on the importance of the transformation. The next industrial revolution has begun.
US and European futures point higher on renewed tech optimism. Fed minutes show policymakers rallying around the higher for longer view on rates. Plus, the UK Prime Minister hopes for brighter days ahead, staking his political future on an improving economy as he calls a surprise summer general election. Labour leader Keir Starmer says it is time for change. Let's check in on these markets then. A bit of a mixed picture across the Asian session, a sell-off over in China, but in Europe you're looking at gains, and largely that will be propelled by the optimism coming through from the beat on Nvidia. It wasn't just the first quarter, it was the forecast around the second quarter as well that was crucial. $28 billion is what's forecast. The gains coming through from Nvidia then after hours. European stocks looking at a lift of 0.3%. The FTSE 100 though dragged a little lower by the commodity space where there is softness across the pricing of copper, iron ore and oil. S&P futures looking to add 0.5%, and Nasdaq looking to add 0.9%, almost a full percentage point, of course, with the tech story squarely in focus for that index. Let's flip this board and look cross-asset then. There was a bit of concern from some investors at the relative hawkishness, that's the interpretation from some at least, around those FOMC minutes. The point that many officials apparently had been questioning whether or not rates were in restrictive territory, restrictive enough at least to get to that 2% target. The US 10-year right now at 4.42 after yields, particularly on the front end, the 2-year did edge higher yesterday on the back of those minutes. The pound, of course, in focus for us today. A bit of volatility coming through for the pound, 127, but there's also the factor around the BOE and rate expectations being pushed back on that slightly higher than expected CPI print yesterday. Brent, $81 a barrel. That's a fourth straight session of softness for oil, down 0.6%. And copper also taking a hit for the third day in a row, down 0.8%, 10,330. Let's get to UK politics now. That surprise summer general election being called, of course, for the UK. A rain-soaked Rishi Sunak making the announcement on Downing Street, the steps of Downing Street, in the hopes, of course, that voters will give him credit for what is a at least relatively brightening economy. The Prime Minister's chosen poll date is a full 6 months earlier than officially required. Let's bring in at this point Adrian Wooldridge, global business columnist for Bloomberg Opinion, who's been writing about this. Adrian, your take on this decision by Rishi Sunak to go with July the 4th rather than waiting?
A very surprising decision. I mean, I think everybody was expecting November. His own party was expecting November, and suddenly he came out with this. I think it's a very personal decision. The party hasn't even got candidates in place in many seats. I think he's throwing in the towel. He had given up on any good news, you know. He didn't want to go ahead. There is no good reason for having this election now.
So his team might counter and say that the economic picture in the UK has turned a corner. The IMF forecasting growth of 0.7%, an upgrade that came through this week. Inflation with a 2 handle at 2.3%. They would suggest, they would make the case that this shows that there is stability now that's come through as a result of Rishi Sunak, and they can build on that.
The numbers are a bit better. Inflation was 2.3, which was not as good as they'd hoped, but certainly better. It's certainly heading in the right direction. But on the other hand, they don't seem to have got the refugees, the boat situation under control. People don't think the economy is turning around, even though it does look as though it is. And they're confronted with a bill for £10 billion for this tainted blood scandal, which means that they haven't got that much money to give away. So I think that they were looking at the autumn and they didn't have enough confidence that things would be really turning around by the autumn. So they just decided, why go through the pain of continuing to govern when you haven't really got that much to offer the country, when you're constantly embarrassed by MPs crossing the floor, by political scandals. There was just no more upside to being in power, I think.
Well, your column on this is brilliant, and you use some very colourful and creative and evocative language. The Conservative Party has been a pointless charade for months. I'm quoting from your piece.
Yes.
It's been bleeding out in public.
Yes.
Put this in the context of this Conservative Party, what it means for an historically an election-winning party that has very few rivals in the scheme of history.
In the scheme of history, the Tory party is a great election-winning machine. I think the chances of this party, of Rishi Sunak winning the next election, are vanishingly small. vanishingly small. I think we're looking at a Labour government and with a reasonable majority, not a massive majority probably, but a reasonable majority. And we're looking at the end of 14 years of Tory rule. And what an extraordinary 14 years it's been. I mean, we have been dragged through a lot of trauma and a lot of crises and a lot of sort of psychodramas of an extraordinary thought. It was very interesting that Keir Starmer said he's going to put an end to the chaos. I think that feeling is, the desire for this political chaos to be finished, the association of the Tories not with stability or with good, strong government, which is their supposedly their brand, but with a period of chaos, is very strong in the voters' mind.
OK, Adrian, thank you very much.
Thank you.
Indeed. Adrian Woodridge, global business columnist for Bloomberg Opinion. And again, really well worth reading Adrian's columns on Bloomberg.com and, of course, on the terminal. Now, sticking with the UK and doing a bit more of a deep dive on the economics of this nation, a measure of the pound's expected swings jumped as traders prepare for that earlier than expected election in the UK. The currency's 2 and 3 month implied volatility rose over 20 basis points yesterday. That's the most since mid-April. From a low level, though, has to be said, but it did spike up the volatility around the pound. At this point, let's bring in Anna Titareva, European economist at UBS Investment Bank. Anna, good morning. Thanks for joining us. Let's talk about the prospects then. The polls suggest there's a 20-point lead. I won't get your views on what the prospects politically. But if we make the bold assumption that we have a Labour Party come July the 5th, what does that mean for your forecast, your expectations around the UK economy? Do you adjust your forecast? Do you expect a pickup in fiscal stimulus? Is there anything that changes materially for this economy?
Yes, I think at this point it's a bit difficult to estimate sort of imminent macroeconomic impact, given that both parties are yet to announce more detailed policy agenda. But of course, going into this election, the key uncertainty and potentially the key risk is indeed around the fiscal outlook. Having said that, however, we know that the fiscal headroom in the very near term is limited, pretty much exhausted. So in terms of risks around potentially big fiscal giveaways, in the very near term, the risk seems to be very limited. However, over the medium term, over the coming years, I think it makes sense to expect a bit more fiscal spending coming through.
And just in the near term, then, in the 6-week period that we have now until that vote, when talking about the volatility around the pound, relative volatility, should we be bracing for volatility through that 6-week period, or is a lot of this already priced in?
So I think the key focus at the moment is on policy agenda and essentially manifestos that are likely to come through in the next few weeks. So depending on what both parties are going to announce, I think it makes sense to expect a bit more volatility. Now,
we had the slightly higher than expected inflation print out of the UK, 2.3%. You're still backing a June cut from the BOE, Anna. That seems pretty bold given the pricing. I think the first cuts that are being priced in by the markets is September, less than 2 cuts now being priced in by these markets for the year. What is your rationale for sticking with June?
Sure. So if we actually changed our call from August to June after the last MPC meeting, and of course yesterday's inflation print was a disappointment, in particular stronger than expected services inflation, and following the print we did flag risks to our call, and we said that once we get more data, and just to remind that we are going to get another inflation print, another labour market report ahead of the meeting, we will see how the risks pan out.
Okay.
But essentially the argument is that looking at our own inflation forecast for the next May print, we think that headline and services inflation is likely to come in just a tenth above the MPC's forecast, and we think that could still allow them to go ahead with the June rate cut.
What about the sequencing then? If you think it's June, with all the caveats, what is the sequencing and how many do you expect over, say, the next 12 months? As we push into 2025, how are you looking at the sequencing?
Yeah, so in terms of rate cuts this year, we expect 3 rate cuts. So in June, August and November, the last 2 rate cuts of the year during the NPR meetings. For next year, we are more aggressive, and we think that towards the end of the year, the MPC will gain confidence about fading risks of inflation persistence and will accelerate the pace of rate cuts. So we essentially expect them to be cutting rates at every meeting next year.
Yeah, it is an aggressive view, down to 2.75% by the end of next year. It will be welcome, no doubt, by those holding a mortgage. Talk to us about the Eurozone. The data is improving across the Eurozone from a low base. What is the sustainability of this turnaround or green shoots that we're seeing in the Eurozone?
Yeah, so I would flag here we're seeing a bit of divergence between what the soft or survey data is telling us when we look at PMIs, and we're going to get another flash print later today. What we're seeing is that in Q4 and Q1, PMIs were actually a bit more pessimistic than the hard data, the actual GDP outcome. And in fact, we did get an upside surprise in terms of Q1 GDP. However, following the release, we did say that in terms of sustaining the stronger pace of growth, we're a bit cautious. And we do think that whilst we are going to see moderately positive growth rates over the next few quarters, it's unlikely to be sort of the repeat of what we saw in Q1. So we expect after 0.3% quarter-on-quarter growth in Q1, we go down to around 0.2 for the next couple of quarters.
The UK government is doing something of a victory lap around inflation at 2.3%. Can the ECB do a victory lap with inflation at levels that we currently see across the Eurozone? Is there any risk to the inflation outlook for Europe?
So our outlook for inflation in the Eurozone over the next 6 months is that inflation will be bumpy. There are a number of base effects coming through. We have a temporary drop close to 2% around September, October, but we are expecting a temporary reacceleration towards the end of the year. But again, it's a bit more mechanical. So at the moment, we think that by the end of the year, inflation will still be around 2.3, 2.4% in the Eurozone. So it seems, based on this forecast, it's a bit too early to say that inflation is sustainably back to the target. However, looking into 2025, we do expect inflation to approach 2% throughout the course of the year.
What does that 2.3% or thereabouts view in the second half of this year do in terms of the constraints on the ECB that we now fully expect, or almost fully expect, to cut in June?
Yeah, so I think even the ECB's projections do anticipate a bit of reacceleration. They've been pretty clear in terms of their communication, also emphasizing the sort of noisiness and bumpiness in the data over the coming months. So I think the focus, and generally when we talk about monetary policy, it's about medium-term inflation outlook. So it's not necessarily the next 6 months, but where the forecasts are pointing over the course of next few years.
How do you factor in the European elections into your views around the Eurozone economy, whether it's a question of fiscal support or shifts to the right within the body politic? How are you thinking about factoring that in to your forecasts?
So at the moment, the focus is on the fact that the right-wing parties are gaining popularity. Now, we don't see sort of an immediate impact in terms of our growth trajectory, but we do take into consideration that potential shifts within the composition of the EU Parliament could imply some changes in terms of policy agenda, a bit more pushback potentially against a green agenda, a bit more pushback in terms of further integration within the union. However, again, we need to see the outcome of the election, and we don't think that it has sort of immediate implications.
OK. Anna Titareva, thank you very much for joining us in the studio to walk through the economics of the UK and the Eurozone as well, with politics, of course, feeding through much of that discussion. Anna Titareva, European economist at UBS Investment Bank. Now to some other stories making the news this Thursday. Consumer spending growth may have slowed, but not for Taylor Swift fans travelling to Europe for the singer's Eras tour. Bank of America says its customers spent 22% more in Paris this month when the singer's tour was in town. Swift performed in the French capital from May the 9th to May the 12th, just when the jump in spending registered. European cities can look forward to a similar boost as fans flock to upcoming tour dates, including London, Milan and Vienna. Swiftonomics still a major factor. Shares of Live Nation, by the way, falling in late US trading as Bloomberg revealed a Justice Department move seeking the breakup of the business over antitrust violations. Live Nation, the biggest US concert promoter, merged with ticketing giant Ticketmaster in 2010. Sources tell us the case is related to Ticketmaster's unrivaled control of concert ticket sales. The merger of the two companies has been the subject of several antitrust investigations in the past. And Bloomberg has learned that Eni is studying a sale of its 20% stake in biorefining unit Enilive. The Italian energy company is working with advisors and is said to value the whole business at about 10 billion euros. Eni is in the midst of a reorganisation to help fund a transition to gas and renewable energy. Plenty more coming up. Stay with us. This is Bloomberg.
Nvidia is supply constrained, meaning that demand for its AI accelerators is still outpacing its ability to supply. So when you look at the guide for the fiscal second quarter, sales of $28 billion plus or minus 2%, it's also interesting to look at where that demand's coming from. The story to this point has been Nvidia selling high-performance GPUs to the hyperscalers, those 3 or 4 big names that operate the data centers behind cloud computing. But that's changing. They're starting to do business with consumer technology, enterprise, government customers, and the market for generative AI in that sense is growing. The 10-for-1 stock split effective June 7th is also interesting, right? This is a stock that trades north of $950 a share. There's a lot of interest out there from the retail investor in the AI story in Nvidia. You just need to take a cursory look at Reddit or X or even Google Trends in real time during the earnings call, and it's what people are talking about. Beyond that, the big piece of news probably was that we will see meaningful revenue, a lot of revenue from Blackwell this year. Blackwell is the combination GPU, CPU, the latest generation of AI accelerator from Nvidia that's becoming much more of a systems vendor, really. But the chips will start shipping in the current period, ramp in the fiscal third, and actually go into data centers in the fiscal fourth. And Nvidia's proving that if the demand's there, it can also keep up in terms of just innovation, bringing a new product to market at a cadence of 1 a year. All eyes continue to be on Nvidia. This is Ed Ludlow for Bloomberg News in San Francisco.
OK, Ed Ludlow reporting there on those Nvidia earnings. Let's get the analysis now and bring in Bloomberg Intelligence and the view there. Bloomberg Intelligence, by the way, saying the results underline the continued strong demand momentum for Nvidia's AI chips, despite investors being nervous as big tech reporting season, of course, started. There have been questions on whether that AI boom has run too far. Most of those concerns have now been allayed, at least for now. Let's bring in the analysis then with Matt Bloxham from Bloomberg Intelligence. Matt, we'll get to the question about the broader tech sector, but let's start with how these results position Nvidia going forward. Ed was talking about the B100, the Blackwell that comes online, Q3, Q4 of this year. That could prove additional momentum, presumably. As you project towards the end of this year and into 2025, how do you see the fortunes of this company adjusting?
Yeah, I mean, I think in the near term, it's just going to continue to go from strength to strength. Now, obviously, it's now a massively bigger company in terms of revenues than it was even just a year ago. Tripling of revenue is huge. But I think, what we're seeing here is diversification of demand. Now, clearly, those big hyperscalers, the Googles and Microsoft, still hugely important companies and customers for Nvidia. And so particularly for that Blackwell chip, Nvidia is still very much positioned as at the leading edge of the AI revolution. And they even said yesterday on the call that there's another chip coming beyond that, and they're on a 1-year cadence for those upgrades. So they're going to continue to keep that leadership, I think, at the kind of AI processing. But they'll also be able to sell their kind of their current generation of chips to corporations and governments. And that's going to bring in new demand as AI kind of seeps into the fabric of what we do on a day-to-day basis, both in our personal lives and what we're doing at work. So I think together those things are going to combine to kind of sustain revenue momentum, definitely through this year and into next.
On the broader earnings picture then, across some of these big mega tech names, is there a divergence? Do we get clarity? Do we get reassurance that there isn't a gap now between the spend, the capex, in the tens of billions of dollars for Meta, Microsoft, Amazon and others on this hardware, and the revenue drive that they get coming through from that? Essentially, can they sustain this spending? Do they have the revenues that are coming through to justify this enormous capex?
I mean, it's a good question, and I think there's definitely a lot more pressure on Google and Meta to generate some kind of incremental return from the sector investment they're putting into all this new hardware. And it's a hugely transitional period for those companies. They're trying to figure out whether generative AI search is something different, or what looks more likely, someone like Google is now merging that into their kind of core search engine, which is ultimately dominant, 80% plus market share in the US. But then we even heard yesterday that Meta is spending money to get training data for its own platform. So you can see a blurring of boundaries even more between these big tech companies as they chase more revenue to justify this investment. So I think that this is going to be a very kind of unpredictable, volatile sector for the next kind of 24 months, I think, as the AI environment kind of shakes out and settles down.
OK, so the volatility will still be there. Very briefly, are there any of the names that jump out across Mag 7 that we should differentiate from the rest of the basket, or can we kind of loop them together within this theme going forward?
It's a difficult one because they all kind of overlap in different areas.
Yeah.
So you look at something like Google, massive search, but also massive or trying to be massive data center and kind of catch up on Microsoft's and Amazon Web Services. So you've got that overlap there with Google, with Amazon and Microsoft, then it overlaps with Meta on advertising. So there's all these kind of different interplays going on. And then you've got Apple, which is kind of slightly kind of, detached from them. Obviously much more of a hardware company, but really trying to get more into services too. And with this Worldwide Developer Conference coming up in June, big question, how do they integrate software and hardware?
Yeah.
What's the next iPhone look like? Is that really an AI iPhone?
Okay.
So that's going to be a bit different too.
Okay, very nice to frame it in that way. Matt Bloxham from Bloomberg Intelligence on the deep dive around Nvidia and the broader tech space. Matt, thank you. There's a lot more coming up. We'll do another deep dive in terms of some of the numbers coming through for Nvidia, but also a quick look at the volatility around the pound and politics. This is Bloomberg. Welcome back. Happy Thursday. Now, life before Nvidia, and the focus was on the Fed minutes. And there was a market reaction to this, a sell-off. And that's why Wall Street ended in the red and yields were up, particularly at the front end, by I think 4 basis points on the 2-year. That's because the Fed minutes quoted officials, many of them questioning whether policy is restrictive enough. And quote unquote, various officials discussing whether or not further tightening was required. This chart is based on an algorithm that crunches the headlines from Fed speak, and it shows you, built by Bloomberg, and it shows you that Fed speak has become more hawkish in the recent weeks. By the way, those Fed minutes coming in, of course, before the most recent CPI data that softened to some extent. So that is the context. But again, the relative hawkishness from those Fed officials. Let's flip the board and quickly look at the UK then. Volatility around the pound on a 2 to 3 week volatility expectations in terms of a 20 basis point move. The spot pound, though, by the way, a lot of it already priced in, it seems. But volatility around the pound is in focus. We're going to be speaking, by the way, to the CEOs of Wizz Air in the next hour. That's just a few minutes away on Markets Today, plus the CEO of Ferrari. Stay with us. This is Bloomberg.